why would investing be any different? Well, today we've got Pete Morrissey, Fund Manager with APN ARIT. That's the Australian Real Estate Investment Trust. Welcome, Pete.
Hi, Ian.
Firstly, just to put in perspective for people listening to this, how long has the APN ARIT been going?
So our ARIT fund was launched in January 2009. So that was in pretty much the depths of the GFC, or as the market was recovering. We just saw a great opportunity for investors to get into real estate, which was really oversold, a major overreaction to the market. It was been a great time for the fund and it's driven performance, but APN as itself, we have a 16-year track record managing real estate securities.
Okay, and you mentioned their performance, and since the fund has been going, over that period of time, what is the performance of the fund?
Well, the fund's performance has been ahead of the benchmark, which is obviously something that we look at, but over that period, I think the since inception figure is around 17% per annum, so it's pretty strong performance. Over time, we would expect the fund to deliver 9 to 11% performance, underpinned by the majority of that total return coming from income.
Well, clearly that's a very good performance, 16.5%. However, we do need to remember that's coming off a depressed time after the GFC. So, look, if we step back one, tell me, what is the key driver for a property fund?
Well, for us as managers, the key driver for real estate is income. So having the security of the cash flows coming out of the underlying assets, that is the key thing for us, because real estate is an income asset class. It's obviously an equity, so it provides you that level of liquidity that a lot of investors want in the post-GFC era, but it's really driven by income. So the manager's job is to lease up the buildings as much as possible, get the best rent, and that rent is passed through to the fund and then on to investors through distributions.
So when we look at that, over the last 5 years, what sort of income has the fund generated?
Probably, obviously, as you said, coming off a lower base, the income of the whole sector, the average income's probably been about 9%. The current income is about 7%, as the market has repriced itself back to probably more realistic levels, and that the current yield is 7% of the fund. But as I said, total return expectations, going forward from here, we'd expect 9 to 11, circa 7% income, and the balance comes from growth driven by CPI, which is coming through rental growth in the leases.
Well, for investors, that's a very strong return. So just reiterating there, about 9.5% gross cash yield. Now, for a New Zealand investor, the bit that you possibly aren't overly aware of, we get caught here with a tax, or we can be caught up in it. It's called the fair dividend rate, FDR for short. That means that the New Zealand investor only pays tax on the first 5%. So if you're getting 9%, or if you have for the last 5 years had over 9%, you've paid tax on 5% and a free carry on the other 4%. Plus, of course, your capital appreciation. So your net return to investors after tax return has just been stunning.
Yeah.
So well done for you, but it is enhanced by our tax legislation.
Sure.
So that's really good. Now, a lot of people look at investing in property. In New Zealand, we probably have an overinvestment in property. So we see one of the advantages of the APN ARIT is diversification away from New Zealand. Another thing with it is also where people have a single asset, they buy a building. What's the cost of being in a syndicate versus being in your fund?
Sure. Well, the real difference is that a syndicate, initially you're going to have to put in a lot more money. So, probably you're looking at a minimum of 25 to 50,000. Second, the liquidity isn't there. So for some investors, that's very suitable. For some, they want liquidity coming through. From a cost perspective, if you went into a syndicate, the NTA your buying price might be $1, but the NTA might be 92 cents. So that's all the costs. The difference between those two numbers, 8 cents, is all the costs.
So buyer beware, and something to get a little bit of advice on.
Just an understanding that.
Yep.
Whereas this fund, you go into it, the fee is 85 basis points plus a buy or sell spread of 25 basis points for transactions and buying, obviously buying stocks. So the cost difference is much, very significant.
Okay, now you mentioned buying and selling there, so clearly liquidity. Now liquidity, using your fund, my understanding is there's daily liquidity on that. Is this correct?
Correct. Daily liquidity. So unlike a syndicate, which you'll be locked into for, say, 5 to 7 years, daily liquidity. So, the same as you can put your money, invest with us. If you want to redeem, you put in your request, and T+3 days, you'll have the money back in your account.
Okay, so that's a key point. Now, as one of the things that we look at for helping people with investments is aligning asset allocation. So when we look at property, what is your view? Is property an equity, or is it a separate class?
Well, I think they should be considering the REITs as a proxy for real estate. It's equity, so you get the benefits of liquidity, but the underlying investments, in fact, are real estate. So you should be looking at it as an asset class that generates income, the same way you would with a syndicate, but it's got that enhancement of liquidity, which you don't get. So we like to see it, and it's repositioned itself now in the post-GFC era as a very, an asset class in its own right, real estate, with a feature that has some liquidity coming through. So that's why I think for many investors it's a great opportunity.
Equities obviously conjures up thoughts around the GFC. So let's go to that. The GFCs, the REITs, they actually were quite badly affected through the GFC. My understanding on that was that really there was too much debt in the system. So how did the debt affect the REITs going into the GFC, and what's the difference today?
Right. The debt was a real driver of their underperformance. At the worst time, when we had this GFC liquidity crunch, debt was at the highest levels we'd ever seen. So the average for the sector was around 44%.
Gee.
What had happened also is that the trusts were very benign in their management of debt, as opposed to what they do now. So in pre-GFC, they'd had 3-year debt profile on average. They'd have a third of their debt rolling every year. The post-GFC, it's completely different. They don't. The key focus is diversifying your debt, so not just going to the banks, using other sources, medium-term notes, offshore debt, USPP, all different sources of debt, and having longer debt. And clearly, their focus is, rather than just getting the cheapest debt, which is always the shortest term and usually the 3-year, focus on getting longer debt, so that in any particular year there's a much smaller percentage of the debt needing to be refinanced.
So being managed a lot more professionally,
yes.
proper treasury arrangements, and effectively de-risking the sector. Well, that's all good news. In fact, I think the current debt levels are around 30% as against 44%. So a major change. Just another issue would be occupancy. Can you quickly talk to us about what's the average occupancy across your fund?
Yeah, sure. In the retail component of the fund, occupancy rates can be greater than 99%. So a lot of the Westfields, the Colonials that we invest into in retail land, occupancy is as high as 99%. So very, very good occupancy, meaning that they're clearly maximising the income coming out of those assets. Office, it's very unusual to get levels of occupancy on average much above the mid-90s. It's just the way the sector works. Obviously, tenants are always moving in and out of buildings. There's a latent level of vacancy that always exists. Currently, the average is probably about 93. Industrial, again, that'll be down a little bit lower. So on average, I'd say across our portfolio, because we have a skew towards retail, you'd be looking at north of 95%, well north.
Okay, for property, and what do you see, and maybe this applies more to individual direct ownership of property, but what do you see as the biggest risk?
A risk obviously is, for a single asset entity, is a tenant leaving. And so that's the biggest risk, I think, for a syndicate which may only own one asset. If the tenant can leave during the period of the syndicate, there could be a major hole in the rental income coming back to investors. So that's clearly a risk. When you're looking at the trusts that we invest into, they hold many, many assets. So that diversifies that individual tenant risk away quite considerably.
And when we look at Australia, where the bulk of the assets are, are we seeing any difference, or what is the difference in the current market between the eastern seaboard of Melbourne and Sydney, etc., and Perth and Brisbane? So in other words, with the change in the resource market.
Well, that's had a noticeable impact in the Perth and Brisbane office market. So the slowdown in resources means that the requirement for office space in Perth especially, and Brisbane to a lesser degree, things have really slowed down. Also, the Perth market is affected by it's got a larger pipeline of new developments coming through, so there's pressure coming from that side as well because tenants have got more choice. But our exposure through the fund to, say, Perth office is quite limited. It'd be as low as 2%, I would have thought, if not less, because generally the REITs we're into are focused on the office markets on the eastern seaboard, and obviously Sydney being the largest, and then Melbourne. So the exposure to those resource states is fairly minimal in our fund, which is a good thing. And on retail, it doesn't seem to have quite the same effect. There's trends that retail performance in the mining states hasn't been quite as good, but overall, it's not so obvious as it is in office space.
Yeah, I noticed that you are big holders of retail, and you have a pretty high percentage of that across the funds, and clearly that's one of the things you like. As a final question, Pete, what sort of capital growth do you target in the fund?
Right. Well, in regard to the retail, it's perhaps high because in Australia there's a big skew towards retail across the index, so it's a natural thing that exists. But the lower yielding retail, such as a Westfield Group, we have a preference away from those. Even the quality is high to the somewhat little bit high yielding stuff that is based around non-discretionary spend, so supermarkets and so forth. As far as capital growth goes, realistically we expect capital growth in line with CPI in Australia. So that tends to be around the 3% level. So the majority of your return is coming out of the income side, so currently around 7%, CPI on top of that, so that's that 9 to 11% range I was talking about. Anything more than that, it's perhaps not going to be sustainable over a long period. Naturally, you get shorter term increases in capital, like that mispricing that occurred post GFC, but sustainable long-term capital growth should be aligned with CPI.
Well, thank you very much. We are supporters of the APN ARIT fund. Things that we like about it are, as you said before, the high dividend payout or the high yield. We think it has been exceptional when you look at cash rates, and average cash rates recently of around 4% when this fund's had 9%. There's been no capital growth, of course, with cash rates, and you've had a capital growth of over 6%, but as you just said, coming off a bad period. But if we're targeting CPI, that's really good. So, and then, of course, for a New Zealand investor, it has actually got an enhancement because of the tax legislation. So, Peter, Pete, thanks very much for coming in, and we look forward to seeing you the next time you're in Auckland. Thank you.
Cheers.
Why would investing be any different?